So the big one today, Wesfarmers reporting a 16% pop in full-year earnings and has hiked the final dividend to 90 cents a share. Revenue also spiking just shy of $34 billion as a booming property market shored up demand for hardware products at its Bunnings stores. The company also unveiling a proposed capital return to shareholders of $2 a share, which, if approved, will total around $2.3 billion. And the start of the new fiscal year, however, has been rocky, with recent lockdowns hammering sales across all divisions, with ongoing disruptions to supply chains driving up costs and impacting stock availability. That's the word from Rob Scott. The market not too pumped up about the numbers. Shares lower, coming off more than 2.5%, with the experts saying while the results were fantastic, in the word of many, it's what comes next that investors are focusing on.
As you drill down into the individual divisions, they absolutely smashed expectations as well. So Bunnings, which everyone was keeping an eye out for, revenue came in at $16.87 billion, up more than 10% from a year ago when it was at $15 billion. So a huge beat there. Same with Kmart. Obviously, the rebranding of the Target stores into Kmart has fared well. $9.98 billion revenue versus $9.22 a year ago. So they grew earnings for Bunnings by $360 million, and they grew earnings in Kmart division by about $250. So that's where really a lot of the growth has come from. That's where it was expected to come from. It has delivered, and it's beat expectations, and they've raised their dividend. I don't usually like to get too excited about results because the market might do something funny and react in a different way, but these look really, really good to me.
Look, I think they're warning shareholders that it's not going to be as good as it was last year compared to this year, because it was a stellar result from Wesfarmers going forward. Strong performance in all of their businesses. Certainly Kmart and Target, they're turning that around, and obviously Bunnings is massive. And I think also people, potentially here in New South Wales are looking at now Bunnings has been closed down. I mean, that's just taking the right of every man to disappear for half an hour to go to Bunnings just to, buy a screwdriver. But look, that's certainly something that I think that we need to keep an eye on, because of some of those stores will probably drag on revenue a little bit. But what I was very pleased to see was that dividend, 90 cents per share, bringing the full year dividend to $1.78. That's about 17% higher from where it was last year. Plus also then giving a $2 share capital return to shareholders. Obviously that has to be approved via the AGM, but I suspect they'll approve that fairly quickly. So yeah, a bit of a mixed bag for Wesfarmers today.
All right, and stick around. In fact, we'll be speaking live with Wesfarmers Managing Director Rob Scott to get all the devil in the detail there and look at the outlook. That is at about 3:30, so coming up very shortly. Stay with us for that. Now, sticking to the consumer staples space, Bega Cheese increasing its full-year profits by about $8 million with a final dividend of 5 cents a share. The board saying the result is a reflection of consistent strategy and in part the acquisition of Lion Dairy and Drinks. That transaction led to a near doubling in annualised revenues and growth in branded product incomes. The final dividend of 5 cents a share. Shares off marginally today. NEXTDC cutting its full-year losses by more than half, with full-year numbers coming in ahead of the company's upgraded guidance provided at the half-year results in February. The recovery is expected to continue, with the company seeing revenues at its flagship service to come in between $285 and $295 million.
When you look at the underlying services that's supporting the growth in the digital economy, it's Microsoft's, Amazon, Google's, they're all providing a plethora of digital services that are helping us, and even in a COVID environment more recently, that's seen an acceleration of those digital services while everybody is coping with, whether it's remote work, working from home, supporting video conferencing, and just using collaboration and online tools. And then there's the consumer side of the market. It's the Netflixes and others, all of those experiencing significant growth. And we have to build the underlying digital infrastructure that supports those platforms. And then it's the enterprise and government segments of the business, those big companies that used to host their own data centers in their offices. And today they're looking obviously to move out of the old office environment and have their computers in a hybrid cloud environment where they're connected to public and private clouds. So those two very significant forces, one is the growth in public and private computing, and the other is the enterprise and government agencies not managing their own data centres on premise anymore. Those two very significant forces are big drivers of our growth.
That's NEXTDC, shares currently down over 5%. Taking a look elsewhere, revenue and earnings down in double digits at Main Pharma, with management blaming the results on its US dollar strategy. No final dividend declared as the full year loss widens to more than $208 million. Shares being hit today, off more than 7.5%. And to some maiden reports now, newly listed Peter Warren Automotive shares taking a dive on a bleak outlook due to the impact of lockdowns in New South Wales and Queensland. Supply of new vehicles also uncertain due to COVID constraints and impact on equipment manufacturers. This despite full year profit more than doubling on the back of strong demand seen in May and June. Dusk also out with its pro forma result after listing in September. The candle maker saying net profit more than tripled to more than $26 million, driven by strong like-for-like and online sales. The company declaring a final dividend of 10 cents a share. Other movers on the market today, Slater and Gordon having one of its best days in a year on the back of a surge in net profit. The law firm saying while COVID hasn't had a material impact on earnings thus far, continued government restrictions may impact performance in the year ahead. Biotech Avita Medical shares surging, narrowing its annual loss by 37% as COVID lockdowns ease in the US. And Mighty Craft shares, they were under pressure, widening its full year loss.
Our coverage of reporting